62 is the strongest data-backed benchmark for retirement, not 65. And those 3 years between the age workers expect to retire and the age retirees actually leave can expose you to roughly $9,600 to $14,400 a year in marketplace health insurance premiums, or $28,800 to $43,200 before Medicare begins. So the number is 62, but it is not a command to retire at 62. It is the age your plan should be able to survive. If the mathematics works at 62, you can still work until 65, 67, or until your office finally replaces meetings with one continuous meeting. The difference is that continuing becomes your decision rather than a financial requirement. The Employee Benefit Research Institute's latest Retirement Confidence Survey puts the median expected retirement age among workers at 65. The median actual age reported by retirees is 62. That 3-year difference looks harmless on a spreadsheet because spreadsheets assume your job remains available, your health remains cooperative, and your employer continues paying part of your insurance. Spreadsheets are extremely confident about events they cannot control. The mismatch becomes clearer at the edges. 39% of workers expect to retire at 70 or later, or never retire at all. Only 10% of retirees actually made it that far. At the other end, 12% of workers expect to retire before 60, yet 29% of retirees report that they did. People are not consistently choosing an earlier date after years of careful meditation beside a lake. Their planned date is losing authority. 46% of retirees in the same survey left work earlier than planned. Among that group, 41% cited a health problem or disability, 35% cited changes at their company, and 36% said they could afford to retire earlier. Those reasons could overlap, which is important. Retirement can be financially possible and still be triggered by something you did not schedule. That changes the central assumption. Continued employment is not an asset in your account. It is a future event with a probability attached to it. A plan that only works if you receive 3 more years of salary and employer health coverage is not yet an age 62 plan. It is an age 65 plan with a 3-year unfunded exposure. You therefore need 2 dates. Your exit-ready age is the earliest age when work can end without turning the next few years into a financial emergency. Your chosen retirement age is the date you actually leave if the option to continue remains available. Confusing those dates is how people end up treating their employer as an emergency fund. I built a digital book called The Exit Code around this exact distinction, the date you hope to leave versus the date your money can support. It turns retirement data into a mathematical exit framework, and the link is in the description. The goal is not to develop a passionate, emotional relationship with the number 62. The goal is to fund 62, then choose later. That gives you 3 years of control that a conventional age 65 plan leaves, dependent on your employer, your body, and the general mood of whoever approves restructuring decisions. And if you appreciate finance built from documents rather than motivational fog, subscribe. I read the boring research, tax rules, and government reports so you can use the parts that affect your account. Being ready earlier costs money, which makes working longer look like the safe default. Yet, waiting has a cost that never appears in a portfolio balance. A New York Life survey of retirees between 62 and 70 with at least $100,000 in investable assets found that nearly half wished they had retired earlier. On average, they wished they had left roughly 4 years sooner. That finding does not mean 46% made a financial mistake by waiting. It means the value of another year changes as you age. At 40, another working year may buy valuable compounding and career growth. At 62, the same year may buy more wealth that you will never spend while consuming time that cannot be carried forward. The happiness research adds context, although it is frequently abused by people trying to prove that quitting your job cures everything. Large cross-country studies have found a broad U-shaped relationship between age and subjective well-being, with the low point landing around the late 40s. One major analysis estimated the minimum near age 47 in advanced countries and 48 in developing countries. Other work using longitudinal data also supports a midlife inflection. But the curve measures general life satisfaction, not the investment return produced by resigning. It combines relationships, health, family pressure, finances, expectations, and work. Researchers also debate how much of the shape reflects cohort effects, statistical controls, and differences between people rather than changes within the same person. The defensible conclusion is narrower and more useful. Around midlife, many people enter a period when the value of time begins rising relative to the value of accumulating another dollar. Your career may still be rewarding, your income may be at its peak. Yet, a year at 58 is not economically identical to a year at 38 because you own fewer healthy future years from which to replace it. The harder data makes that distinction uncomfortable. The Centers for Disease Control and Prevention reported an age-specific death rate in 2024 of 386.9 per 100,000 people between 45 and 54. For ages 55 through 64, it was 859.8. Between 65 and 74, it reached 1,772.9. The rate more than doubles from the first group to the next, then roughly doubles again. That does not show that working causes mortality, and it certainly does not prove retirement extends your life. It shows that healthy time is a depreciating asset, which is mildly inconvenient because the retirement industry prefers discussing time as though everyone receives unlimited extensions. This creates a real conflict. Delaying retirement improves nearly every financial input. You earn more, contribute more, give the portfolio more time to compound, shorten the withdrawal horizon, move closer to Medicare, and increase the Social Security benefit available later. Financially, later is cleaner. Biologically, later is not refundable. That is why the correct decision is not to quit at the earliest possible age. It is to make the earliest relevant age financially survivable. For the typical late career American plan, the current data says that age is 62. You fund the option, then decide whether using it is worth more than another paycheck. Funding it begins with the withdrawal horizon. The famous 4% rule is often presented as though 4% were engraved on a stone tablet discovered beneath the New York Stock Exchange. In reality, the rate depends on the length of retirement, portfolio mix, market conditions, spending flexibility, and how much certainty you demand. Morningstar's latest retirement income research estimates a 3.9% starting withdrawal rate for its base case, inflation-adjusted spending, a 30-year horizon, and a 90% probability of funds remaining at the end. That is a research reference, not a guarantee. Extend the same planning horizon from 30 years to 35, and Morningstar's base rate falls to roughly 3.5%. 5 extra years do not sound dramatic until you translate the decimal into capital. Take an illustrative annual spending level of $61,400. At 3.9%, supporting that entire amount from a portfolio requires roughly $1.57 million. At 3.5%, it requires about $1.75 million. Moving the retirement runway 5 years earlier creates a difference of approximately $180,000 before Social Security, a pension, rental income, or any other reliable cash flow reduces the burden. The important phrase is supporting the entire amount. If Social Security will eventually cover $30,000 of that spending, your portfolio does not permanently need to produce $61,400. It must cover the remaining long-term gap, while separately carrying the temporary years before that reliable income starts. This distinction prevents you from inflating every temporary cost into a permanent portfolio requirement. If you need $36,000 for a 3-year insurance bridge, you do not divide $36,000 by 3.5% and conclude you require another $1 million forever. It is a finite liability with a defined ending date. Treating temporary and permanent spending as the same problem makes early retirement look far more expensive than it is. The withdrawal horizon prices the permanent part. It immediately exposes the temporary part. Health insurance from 62 to 65. A rough gross planning range for one person in that age window is $800 to $1,200 per month, depending on location, plan level, household composition, tobacco rating, and subsidy eligibility. That produces the opening range of $9,600 to $14,400 a year. Current national figures show that this range is not exaggerated. KFF estimated that in 2026, the average unsubsidized annual premium for a 60-year-old was $11,625 for the lowest cost bronze plan. The benchmark silver plan averaged $15,914, meaning a real quote can land above the planning range before deductibles and other out-of-pocket expenses enter the room and begin eating snacks. Against a $35,000 annual portfolio withdrawal, premiums of $9,600 to $14,400 consume roughly 27 to 41% of the cash. This is why someone can have a seven-figure portfolio and still feel trapped by a health insurance card. Yet the 3-year amount should remain a bridge, not become permanent lifestyle spending. Medicare eligibility at 65 changes the coverage structure. Medicare is not free, and premiums, supplements, drug coverage, deductibles, and cost sharing still belong in the later budget. But the specific marketplace exposure between 62 and 65 ends. That creates a finite target. Your accessible assets need enough capacity to pay the net insurance bill during those years without forcing damaging portfolio sales. The word net matters because two households facing the same gross premium can pay radically different amounts after premium tax credits. And that is where the retirement age question stops being mainly about portfolio size. The Enhanced Affordable Care Act premium tax credits expired at the end of 2025. For 2026, premium tax credit eligibility generally ends when household income exceeds 400% of the federal poverty level. Within the upper qualifying band, the applicable contribution percentage can reach 9.96%. That means the amount and source of income you generate in retirement can change the price of your health coverage. A large traditional IRA withdrawal can raise modified adjusted gross income. So can a Roth conversion, taxable interest, dividends, and realized capital gains. Even tax-exempt interest and the non-taxable portion of Social Security can matter in the marketplace income calculation. Now the absurdity becomes useful. You may withdraw more money to make the healthcare bridge feel safer, then discover that the withdrawal reduced your subsidy and made the healthcare bridge more expensive. You added cash on one side and increased the bill on the other. Retirement planning has successfully reinvented the revolving door. Crossing the income cutoff can be especially painful. For a household near 400% of the poverty level, one extra unit of modified adjusted gross income is not economically equal to the previous one if it pushes the household beyond eligibility. The marginal cost can include federal tax, state tax, and the loss of premium assistance. Your account statement will not display that combined cost because apparently clarity was considered too luxurious. This was never only a question of whether your portfolio is large enough. It is a question of whether the right dollars are available at the right time without generating the wrong income. A taxable brokerage account illustrates the difference. Selling an investment there does not create a retirement account early withdrawal penalty. Only the gain above your cost basis is generally part of taxable income, not the entire sale proceeds. If you sell $40,000 of assets with $30,000 of cost basis, the income effect may be based on the $10,000 gain rather than the $40,000 of cash you received. A traditional retirement account withdrawal behaves differently. The taxable portion generally enters ordinary income, and before age 59 and a half, it may face an additional 10% tax unless an exception applies. The cash amount, taxable amount, and marketplace income amount can therefore be very different depending on where the money came from. This is the failure inside the standard advice to max your 401k and wait until 65. That advice can build a large total balance while leaving an early retiree short of accessible bridge assets. It solves accumulation, but it may not solve timing, healthcare, or tax control. $1 million is comforting until accessing it creates a penalty or changes a subsidy. Knowing these numbers and building a system around them are two different jobs. I built a digital book called The Exit Code because retirement calculators tend to flatten every dollar into one balance and every year into one smooth average. The book analyzes 50 years of retirement data and turns it into a mathematical framework for exiting the rat race. For this decision, the relevant parts are the $14,000 invisible bill created by the pre-Medicare insurance gap, the 4% trap, and the dynamic withdrawal method that replaces it, and the framework that converts maybe someday into a defensible date. It is 8 chapters of research without filler, written for someone who wants the mechanics rather than a motivational speech beside a rented sports car. You can get it for less than a dinner out through the link in the description. Every extra year of uncertainty still has a financial and biological cost, so the useful output is a date you can test. The bridge depends on access, and access has its own clocks. At age 59.5, the general 10% additional tax on early distributions from traditional IRAs and qualified retirement plans stops applying. Income taxes can still apply. The government has not become generous. It has stopped adding the extra charge for arriving early. There are exceptions before that age. If you leave an employer during or after the calendar year in which you turn 55, distributions from that employer's qualifying plan may fall under the separation from service exception. That rule generally does not follow the money if you roll it into an IRA. Section 72T also allows substantially equal periodic payments under strict conditions. Altering that arrangement too early can trigger recapture tax and interest, which is the tax code's way of making flexibility feel rebellious. These exceptions matter, but they do not make every retirement dollar interchangeable. A plan that depends on an exception should model the exception accurately, rather than writing access money somehow in a spreadsheet cell and coloring it green. Roth money creates another common blur. Regular Roth IRA contributions are treated differently from earnings and conversion dollars. Under the ordering rules, regular contributions come out first, followed by conversion and rollover amounts, then earnings. A return of regular contributions is generally not included in gross income. Conversions carry a different clock. Each conversion generally has its own 5 tax year period for purposes of the early distribution additional tax. Taking taxable conversion amounts out before that period ends can trigger the 10% additional tax unless another exception applies. The 5-year conversion clock is also distinct from the 5-year rule used to determine whether Roth earnings are part of a qualified distribution. So I Have Roth Money is not an access plan. You need to know how much represents regular contributions, how much came from each conversion, when those conversions occurred, and how much is earnings. The account label is one word. The tax treatment is several pages, because retirement apparently needed lore. This matters less for someone exiting at 62 because the age 59.5 threshold has already passed. It matters enormously if you are building the option to leave in your 50s. Your exit-ready date can be delayed by inaccessible assets even when your long-term portfolio is more than adequate. Subscribe if you want the rules translated into consequences for your own portfolio window rather than recited like a tax seminar. Once access is mapped, the phrase retirement age breaks into several economically different gates. Age 59.5 changes the general early distribution penalty treatment. That can release retirement accounts for spending, although the withdrawal may still increase taxable income and affect marketplace assistance. That access reveals the next decision at 62, when Social Security retirement benefits become available. Claiming can reduce the amount your portfolio must provide immediately, but it permanently changes the monthly benefit. For someone born in 1960 or later, full retirement age is 67. Claiming at 62 provides 70% of the full retirement benefit. If the full monthly benefit at 67 would be $3,000, claiming at 62 produces about $2,100 per month, or $25,200 a year. Waiting until 70 would produce roughly 124% of the full benefit, or about $3,720 per month in that illustration. That is $44,640 a year, a difference of $19,440 compared with claiming at 62. Claiming at 62 lowers the portfolio withdrawal required during your early retirement years. Delaying increases later guaranteed monthly income, but forces accessible assets to carry a longer Social Security bridge. Health, expected longevity, taxes, marital structure, survivor benefits, work income, and tolerance for drawing down investments can change the result. If delaying requires selling stocks after a major decline, the higher future benefit may come with damaging withdrawals today. If accessible assets are abundant, the bridge may let you buy a larger inflation-adjusted lifetime income stream through delayed claiming. The correct age emerges from household cash flow, not from a slogan. Then, age 65 moves healthcare from the marketplace to Medicare eligibility. That can collapse a large temporary insurance gap, but it does not automatically lower every household's total medical spending. It replaces one cost structure with another, and removes the specific need to manage marketplace premium tax credits. The disappearance of that subsidy issue can create a new tax planning window. After Medicare begins, but before Social Security or required minimum distributions fill the tax return, some households may have more room to recognize income. For someone who reaches age 73 under current rules, required minimum distributions can later force taxable income from traditional accounts, whether spending needs it or not. That makes the years between retirement and those later income gates valuable. A low-income year is not empty space. It is tax runway. You can use it badly, use it well, or accidentally give it to an insurance premium. Age 67 supplies the full Social Security retirement benefit for people born in 1960 or later. It is not an official recommendation to stop working. Neither is 62, 65, or 70. These ages open and close cash flow gates. They describe what becomes available, not what you should want. Now, the personal number can be calculated without pretending that an average household lives your life. Start with annual spending that reflects what will actually leave your household. A national reference, such as $61,400, is useful for seeing the scale, but it is not your retirement budget. Your housing, travel, family support, debt, state taxes, charitable giving, and healthcare can move the number by tens of thousands of dollars. Your spending figure also needs consistent treatment. If it is after-tax spending, you must add the taxes required to produce that cash. If marketplace premiums are already inside the spending total, do not add them again. If Medicare costs replace marketplace premiums at 65, change the amount at that date instead of pretending healthcare remains flat for 35 years. Then, subtract reliable income that arrives during the period being measured. Social Security, a pension, and other dependable cash flow reduce the amount the portfolio must provide. Do not subtract future Social Security from a year before you plan to claim it. Money scheduled for age 70 cannot pay an age 63 premium unless accessible assets bridge the difference. What remains is your ongoing annual gap. Your long-term portfolio must sustainably support that gap over a defensible horizon. If annual spending, taxes, and insurance total $80,000, and reliable income eventually covers $35,000, the long-term portfolio gap is $45,000. At a rough 3.5% planning rate, a permanent $45,000 gap points to about $1.29 million of portfolio capital. That does not mean 1.29 million guarantees success. It means the long-term equation has a transparent starting target under those assumptions. A flexible spending plan can support a higher initial withdrawal than an inflexible inflation-adjusted paycheck. Morningstar's research found that certain dynamic methods could support materially higher starting rates because withdrawals fall when the portfolio struggles. But flexibility only exists in the portion of spending you can reduce. Property tax does not care that the market had a difficult year. Neither does food, basic insurance, or the roof. Travel, gifts, vehicle upgrades, and other discretionary spending may be adjustable. The ratio between fixed and flexible spending determines whether a higher initial rate is a tool or a future argument with yourself. Passing the long-term equation still does not make retirement possible. It proves the portfolio can fund the destination. It says nothing about whether you can reach it. The bridge equation handles that. Accessible assets must cover every temporary deficit before the relevant gates open. For a 62-year-old, that can include 3 years before Medicare, several years before the chosen Social Security claim age, and any period when the desired withdrawal source would create excessive tax or marketplace income. Suppose your ongoing long-term equation passes because future Social Security lowers the portfolio gap. You could still fail the bridge if most of your assets are inaccessible, if the available withdrawal creates a large tax bill, or if realizing income pushes marketplace coverage beyond the subsidy cutoff. Your retirement is sustainable after the bridge, but underfunded before it. This is how someone with more total wealth can have a weaker age 62 plan than someone with less. The second household may own more taxable bases, cash, seasoned Roth contributions, or other accessible assets. The first household may have concentrated nearly everything inside tax-deferred accounts, and assumed account value was the same as spendable value. The tax runway is therefore a timing asset. It measures how long accessible accounts can support spending while letting you choose when taxable income appears. A taxable account holding $300,000 is not automatically $300,000 of runway because market risk, cost basis, dividends, realized gains, and the size of the annual deficit all matter. But it can purchase several years of control that a larger traditional account cannot provide in the same form. This is not an argument for one universal withdrawal order. Taxable assets may be valuable for subsidy control, yet preserving them could also be useful for flexibility or estate planning. Traditional withdrawals may fill lower tax brackets, but they can increase marketplace income. Roth withdrawals may protect adjusted gross income, but spending Roth assets early can sacrifice future tax-free compounding. Each source changes more than one variable. The relevant question is which constraint moves your exit-ready age. If the long-term equation fails, the problem is ongoing capital. Lower recurring spending reduces the permanent gap. More reliable income reduces the burden on the portfolio when that income begins. Additional work adds savings and shortens the horizon. Spending flexibility can change the sustainable withdrawal assumption, provided the flexible amount is real. If the long-term equation passes but the bridge fails, working several more years is not the only possible response. A smaller, temporary insurance cost, more accessible assets, a different Social Security date, or lower taxable income during marketplace years can shorten the unfunded exposure. The solution must address the bridge, rather than mindlessly adding permanent capital. If healthcare is the binding constraint, the age may jump directly towards 65 because Medicare ends the marketplace, period. If account access is binding, 59.5 may turn the indicator green. If Social Security is required to close the annual gap, 62, 67, or the chosen claim date may become decisive. If taxes are creating the failure, the answer may depend on income timing rather than another birthday. This is the advantage of keeping two indicators. A single retirement score can tell you that the plan failed. It cannot tell you whether the missing ingredient is capital, insurance, tax control, or access. A failure with a name can be repaired. A red probability meter mostly encourages you to stare at it. Now pull the conventional age 65 plan backward to 62. Remove the final 3 expected salaries. Remove 3 years of employer health coverage. Extend the portfolio horizon by 3 years. Add the marketplace bridge. Recalculate income under the 2026 subsidy rules. Then verify that the cash required during those years can come from accessible sources without relying on a penalty, an unseasoned conversion, or an implausible market sale. The ongoing indicator turns green when sustainable portfolio withdrawals plus reliable income cover recurring spending, taxes, and insurance over the full horizon. The bridge indicator turns green when accessible assets cover the temporary shortfalls before retirement account access, Medicare, and the selected Social Security date change the cash flow. If both indicators remain green after the age 65 plan is pulled back, 62 becomes an available exit. You do not owe the calendar a resignation letter. You have removed 3 years of employment dependency. If the ongoing indicator turns red, the plan needs more permanent support. The amount of the failure tells you the capital shortfall. A $10,000 annual deficit at a 3.5% planning rate represents roughly $286,000 of additional capital, absent another adjustment. If the bridge alone turns red by $30,000, you do not necessarily need another $857,000 of permanent portfolio wealth. You need to fund or shorten a $30,000 temporary gap. That is a very different problem, and mercifully, a smaller one. If both fail, the personal date moves later until both pass under assumptions you can defend. A year of work can help several variables at once. Another year of contributions, another year of compounding, 1 fewer withdrawal year, a shorter healthcare bridge, and movement toward income gates. That is why retirement readiness can change quickly in the early 60s. But working longer should fix a measured failure, not calm a vague fear. Fear has no finish line. It will request 1 more year at 62, then another at 63, followed by a brief performance review at 64. Mathematics can state which year actually changes the plan. The public benchmark is 62 because that is where the latest worker and retiree data says reality clusters, despite the planned age of 65. The regret data warns that unnecessary delay can consume roughly 4 years people later wish they had reclaimed. The mortality data says those years are not interchangeable. The healthcare and tax rules explain why reclaiming them requires more than hitting a portfolio balance. Your personal exit-ready age is the earliest age when both coverage tests pass. Sustainable portfolio withdrawals and reliable income must cover the ongoing annual gap. Accessible bridge assets must carry every temporary gap before the relevant account, healthcare, and Social Security gates open. Funding 62 does not require retiring at 62. It buys the right to say no at 62 without turning a company decision, a diagnosis, or an insurance bill into a crisis. If you keep working, the extra income strengthens a plan that no longer depends on it. I have spent more than a decade running a business around accountants and fiscal lawyers with multiple hundreds of thousands of dollars invested. And the recurring lesson is that the decisive error is rarely difficult arithmetic. It is the brain treating a controllable option as though it were a feeling. Lazy investing built more fortune than crypto memes. Run your plan backward to 62 and subscribe if you want more decisions reduced to the numbers that actually move them. When both indicators turn green, every paycheck after that is optional rather than structural. That is the perfect retirement age. The first age when your mathematics no longer needs your employer. The first age when your mathematics no longer needs your employer.